Good afternoon, everyone. We are glad you've joined us today for our presentation about student loans. This is a wonderful time for us to talk more about this topic, as well as for you all to ask questions. So please don't hesitate to put questions either in the chat or the questions panel as we talk through this information. I would like to introduce myself. I'm Sarah Scruggs. I'm the Community Engagement Specialist at Harvard University Employees Credit Union. About halfway through this, Migdalia Gomez will join us, and she's the Community Engagement Manager at the credit union. The credit union is a not-for-profit financial institution of Harvard University. We offer everything that a bank does, but we believe we do it better because we are exclusive for the Harvard community. So we make products as well as services that benefit directly our community specifically. And that includes all of you at Beth Israel, and we are so glad that you've joined us today. If you are a member, wonderful. Thank you so much for being a member. If you're not a member and you're looking for a new financial institution, we are more than happy to help you with that and to talk about what we can offer you and how we can serve you best. So if you have questions, don't hesitate to reach out to us. This is part of a series that we're doing with Beth Israel. So if you are interested in this particular topic, wonderful, but we do have some other ones coming up. We've actually planned them all out, I believe, through next year. So please don't hesitate to go on our website. That is hvcu.org/BIDMC, where you can find the registration links for all of the upcoming webinars. And if you're not able to attend, but you'd like to get the information, the best way to do that is to go back to this page because we do put up the information, the slides, and any other handouts that we may have on this website. So it's a great place to go if you're interested in a topic, but maybe you have work that day or something just doesn't work out. You can always go back to this page to get that information. We want to get started today pretty quickly. This is a lot of information to go over within the hour, and we want to make sure that we're able to talk about it all. So thinking about the steps to student loan repayment, you first need to understand your student loans, what type of student loans you have. Then you need to know your repayment options. Research your federal loan forgiveness. That is really important, as I know we're talking to people who are probably extremely interested in that. And then also speaking briefly about refinancing, whether that be from a private to another private. So we do have some more information about student loan repayment and refinancing. If you would like to go and look more into that, specifically from the view of the credit union and how we can help with that, we do have that website. So don't hesitate to reach out to us if there's information that you feel like you still need once this presentation is over. We'll get started with understanding your student loans. So there are a few different types of student loans. The first and probably most common that a lot of people have, and everyone is offered this if they fill out the FAFSA, and that is the federal student loans. These are the direct subsidized and unsubsidized. If you went to school, and a few years ago, we'll say that, these may have been called the Stafford loans. And then there's Perkins loan as well as PLUS loans, federal PLUS loans, parent or graduate PLUS loans. You have state level loans. These are going to be directly from the state, whether that could be Massachusetts or Alabama, Georgia. Different states offer different things for students. Some states offer this aid, some don't. But it's good to know that you possibly have one of these loans as well. And then there's the private loans. These are loans that you would have had to have applied for outside of the FAFSA. You would have had to fill out an additional application for these. These are run directly through private entities, so not through the federal government. They're either from schools, credit unions or banks, or private companies. Sally Mae is one that you'll hear a lot. So these are private student loans, different than your federal student loans, and federal is going to be probably the one that most people have. We'll talk first about those federal loans. Like I said, they were formerly Stafford loans, and you got these as a student going into college. You did not have to get a credit check to receive these, but they are in your name. And that's something that's really interesting, is that they are in the student's name, no matter how old that student is. They're particularly in the student's name. And the subsidized, you'll see that there's the subsidized and unsubsidized. The subsidized direct loan is only available to undergraduates. This loan does not accrue interest while the student is in school. And so this loan is only available to undergraduates, and unfortunately doesn't go all the way up to graduate school as well. And these loans are deferred while you're enrolled in school at least half time. So you did not pay on these loans while you were in school, more than likely, or you weren't required to. And so these are deferred while you're enrolled at least half time. And then once you graduate college and you're no longer in university, you have that 6-month grace period to begin paying them. Hopefully this is enough time for people to find a job or to be able to get a living situation all worked out. And the rates are all based off of when you borrowed. So let's say you went to college and took out loans for 2 years. You'll have 2 different rates, that means, because the rates are based off of when you borrowed, and the rates do change from year to year. So each loan has a different rate. So the Federal Plus and Graduate Plus loans are different from the subsidized and unsubsidized. The subsidized and unsubsidized are offered to every student, or unsubsidized is offered to every student who applies for the FAFSA. The Federal Plus and Graduate Plus loan are in addition to those loans if the student applies for them. The Parent Plus is for students in undergraduate, where the parent is asking for additional funds to help send their child to school. The student has to complete the FAFSA for the parent to be able to apply for this. There is no grace period with these, but a lot of parents do request deferment while the student is in school, so that the student can begin paying them off once they do graduate. I've seen that quite a bit. So you may have a plus loan on your account, even if you're not a parent. Your parent may have signed that over to you. And the interest rate, again, will vary. It's depending on when the loan was dispersed. Okay, and these are all from the Department of Education. You may have a Graduate Plus loan, which would be in your name. As a graduate student, it would be in your name. You would have that credit check. And there is a small grace period for Graduate Plus loans, so that hopefully you can find a little bit of a higher paying job once you're done with graduate school. You can find all of this information about federal loans on studentaid.gov, but what I want to point out specifically about studentaid.gov right now is the best news is that all federal loans right now are at 0% interest. They have been since, I believe, April. And so you shouldn't have been getting any interest charged on your account since then. And it's until December 31st of this year. So it's through the end of the year. We don't know what's going to happen next year. But right now, this is a really great thing to make sure that you're not paying that interest. So if you're still able to continue paying your federal loans, you're now able to pay on the principal, which is a wonderful thing. That means you'll see your number of the amount of loan that's due go down a little bit during this time if you're still able to pay. If you're not able to pay right now, that's okay. You do not have to pay your federal student loans at this time right now until December 31st, but we do recommend that you continue paying them if you can. Like I said, it's a great time to get that principal down lower and lower. So I really encourage you, if you're able, continue to pay. If you're not, this is an okay time to not pay those as well. Private student loans, talking a little bit more about those. Each private loan is very different. So I won't go into any specifics about these loans really, but just to let you know, if you do have one, these are going to be directly from a bank, like I said, a private company. The interest rate, grace period, and all of the repayment terms will vary based on the lender. Every lender has their own rules, own things that they do with these. So unfortunately, there's not something across the board that works for all of them. There are potential benefits to private loans. There's a cosigner release option, which this means after, I believe, 40 months of on-time payments, the cosigner can be released from that loan. So let's say you needed a loan when you were a student in school, you were 20 years old, maybe you didn't have proof of income or great credit, and so someone else co-signed with you. After 40 months of on-time payments, this cosigner can be released from their co-signee duties. So that's good to know and something to think about if you have made those on-time payments. There could possibly be a small interest rate reduction if you enroll in auto pay with these entities. So if you have a private student loan through the bank, there could be a small 0.02% interest rate deduction if you do enroll in that auto pay, so that the bank knows, okay, they're going to be paying every month because we auto enroll and we take it out. So you need to know the details. The best place to go for all these details is federal student aid. And this is studentaid.gov, like I said again. And if you just click on the Manage Loans tabs, you'll be able to know a little bit more about repayment and see the details of all of your loans particularly. What does this website have on it? So it has amounts, rates, and terms for each of your loans. These three things could be different for all of your federal loans, right? So your federal loans could have different rates for each year that you took that federal loan out. So you'll be able to go into this website and see all of those things. And we definitely recommend pulling your credit report for any private student loans that you may have. This will only give you the federal student loans. So it would only give you those federal student loans, not the private student loans that we also spoke about. You can pull your credit report at annualcreditreport.com. The great news is during coronavirus, they have started to make it available for every consumer to be able to receive their credit report weekly from the three bureaus. You probably don't need to check it weekly, but I do recommend checking it maybe once every 3 months. It's a pretty good timeline to be able to do, and you can take it out from each of the three bureaus. This is happening until April 2021. If you've never read your credit report before, I definitely recommend pulling this, looking through it, learning a little bit more about it, especially if you have a private student loan. That will come up on your credit report. If you have a federal student loan, that will also be on your credit report. Paying those off on time will absolutely impact your credit. So continue to make those on-time payments. Now we're on to step 2. We've now figured out, okay, these are the different loans that I have and the different types that I have. So now we need to figure out what are our repayment options at this point. Federal repayment options. Federal loans have the most repayment options of any of these loans that you'll probably see. There's the standard. This is what you're automatically enrolled in. When you finish school and graduate, you will be enrolled in the standard plan. You make equal monthly payments up to 10 years on these loans. Pretty easy. We get that, we understand that. There's graduated. These are for people who believe that right now I'm making a smaller amount of money than I'll be making in the future, but I still want to make sure that I'm getting these paid off within 10 years. So your payments will increase over time. As you hopefully move up and you're able to earn a little bit more money, maybe get raises each year, you're able to pay a little bit more towards that student loan. And then there's extended. This is only available for borrowers who've borrowed over $30,000 in direct loans. And so these are the direct subsidized and unsubsidized loans. So if you've borrowed over $30,000, you can extend your terms all the way up to 25 years. And this is a good option for people who do have that large sum of loans to pay back. And again, like I said, studentaid.gov has all of this information as well. So don't feel like you have to write everything down really quickly. Just note that these things are also on their website. You've probably heard of federal income-driven plans. These plans are pretty popular and there are quite a few. So I don't want to overwhelm you, but I do think it's important that you see all of these because there are a lot of options. Like I said, federal loans have the most options for repayment, whereas private student loans, you don't have as much flexibility. And with state loans, there may not be as much either. The most popular one out of these is going to be the second, and that's the income-based repayment. And this is based directly on your discretionary income. And so this is a great option for people who aren't making quite enough to cover all of their student loan payment for the standard option. But the maximum payment that it can be is 15% of your discretionary income, so that you're able to pay for things like rent and groceries and food, transportation. And the good news about the income-based repayment is if you continue to make on-time payments and you're making sure that you're paying it off as required, your debt could possibly be forgiven after 20 or 25 years in repayment. That may sound like a long time, but it could be a really good option for people whose income doesn't allow them to make those standard payments, but they're able to pay that off little by little. And then after 20 years, there could be a little bit forgiven. So that is good to know as well. And I really recommend, if you're interested in any of these plans, going on to studentaid.gov and looking up more information about it. Like I said on studentaid.gov, they'll actually lay out all of these plans for you and what that would look like for your specific loans. So you would see this laid out for you on their website so that you can see, okay, what may be the best for me right now? What type of payment plan might be best for me? And I absolutely recommend that you do this, you look through this. Taking this step will just help you to know more. You'll see that some plans, you'll pay more in interest over the life of the loan. And whereas some plans, you may pay more in interest, but you're able to do a more feasible monthly amount. So I definitely recommend that you take a look at these and really compare and contrast. Okay, what do I need for myself right now? And what will set me up for success in the future? Because that is so important that you do those things.
Thank you, Sarah. A question came in from one of our attendees. Can you switch between plans? I'm not sure if you want to take that or if you want me to answer.
You can go ahead, Migdalia.
Okay. So yes, you can. So if you decide that, and this is very common, so I definitely don't want people to feel like, oh, I don't want to do this. It's not common. It's very common, and you have to keep in mind, you want to do, as Sarah's mentioning, what's best for your situation. So if you just decide to initially take standard, which is very common, and then change because maybe your income has changed or maybe your needs have changed into an income driven, you can do that. So just because you choose one plan does not mean that you're limited to that plan for the life of your loan. Of course, there are things to consider that if I go from a standard to an extended, my monthly payments may change, will most likely change, and vice versa. So there will be changes to your payments that you just have to account for. But your student loan servicer can help you with that. And servicers are they're in the process of changing. So I'll put a link to our blog. We put up a blog article, I believe it was Monday or Tuesday of this week, with more details. So if you have a specific servicer, it may be that in the next couple of weeks or months, you may have a new servicer, and we detailed on our blog some steps that you can take to walk through that process and go through that process seamlessly. I'll turn it back over to you, Sarah.
Thank you, Migdalia. That's a great question, and definitely something to be aware of. That the good news here is that if you pick a plan and find that it's not working for you and your family, that there may be another plan out there that does work better. Like Migdalia said, speak it over with your servicer. They're there to help you. And hopefully, if you do transition to a new servicer, you're able to connect with them pretty soon after that switch. Actually, Migdalia, I think this is where you start on the presentation, so I'll hand it back over to you.
Thank you, Sarah, and thank you, everyone. Please feel free to keep submitting your questions. Sarah and we have a couple more slides to go, but we really are here to help you answer your questions. I know Sarah gave a brief introduction as to who we are, but I just want to remind you, I've specifically have worked in student financial services. I've been the director of student financial services for both undergrad and grad. And before that, I worked for the state authority here in Massachusetts. So you're in good company for questions. If there's something that we don't know between Sarah and I, we will definitely find out for you. One of the big things when it comes to student loans, and something that most people will face, is that there may be times that your budget just makes it a little bit challenging, or sometimes a lot challenging to make payments. As a result, we have seen with COVID-19, specifically the federal government did drop those interest rates to 0 to help. But this is something that has never happened before, and it is something that has been extended but will not be permanent. So what are your options once the interest rates go up? And specifically, we're talking federal with some of these options, but I will talk about some of these that can also be helpful for when it comes to your private loans. So one of the things that you could do is deferment. And what deferment means is that you are not required to make payment. Now, anyone that took out a federal student loan, you have already experienced deferment, because while you were in school, at least half time, those payments were not required. Your loans were deferred while you were enrolled. That's the most common use of deferment, and it is at least half time in school. That doesn't mean just undergrad, that means grad. So if you're completed your undergrad degree, go back to school for a grad degree, or go back to school for some other certificate, as long as it fulfills the requirement at that institution for you to be considered at least half time in an enrolled program, your loans will be deferred. That is something that we like to say happens automatically, but truthfully, there are, as everything, there are steps behind the scenes. So even though we say automatically, what happens is that the registrar's office will, typically the registrar's office will report that you are attending school. That typically takes some time, but if you're ever in a situation that you're going back to school and you realize, you know what, they're still requiring payment from me, that's when it's always good to check in and with your service, or check in with your school and see that you're being reported as attending school. The other reasons aren't as common, though they do exist. But the reason that we want to put them here is that if you're having a hard time, first you want to make sure, am I required to make payment? And if not, can I take advantage of a deferment? Deferment is ideal because with deferment, since you're not required to make payment, it is more favorable because that interest is not accruing. But not every time, you may not qualify for deferment. You may instead need to go with the forbearance. Now, a forbearance is another opportunity in which you don't have to make payment. But the difference here is that there's more that's required on your end, because you're basically saying, I don't qualify for deferment. I'm not attending school at least half time. I am not in a situation in which I am in active duty. I am not temporarily disabled. So there are things that you don't qualify for. So they're going to ask you for additional paperwork to, okay, if you don't qualify for deferment, why is it that you're asking for forbearance? And that paperwork, it's not to scare you. It's not to say it's going to be anything extensive. You may just have to complete an additional form here or there. This does extend the repayment period, but that interest is accruing, which is why it's still a better option than not making payment. And I will talk a little bit about the consequences of not making payment, because it is important for you to know what could happen if those payments are not made. Again, this is not the case right now with the federal loans, but we are saying this because most likely we are probably going to see across the nation, once student loans, the 0% interest rate is no longer available and the interest rates go back to normal, there still may be people that are underemployed or unemployed, and they may need to stop making payments. So we just want to make sure that you're aware of some consequences so that you would not be surprised if this were to happen. And one of the consequences is that because these are federal student loans, the federal government can garnish your wages. They can, and this is something that we have seen. I have seen this many times, and unfortunately, those that were affected are typically the ones that are in need of that income. And that means that if you were expected, I'm just gonna say use simple math here, but let's say that you were going to get a paycheck for $500, you might get a paycheck for $400. Like that money is gonna be taken out before, like the government's gonna come in, take a certain amount before you, and you won't have access to it because you owe that. It's very similar like with back taxes. And that's another thing too. They can actually, and this, I've also seen this unfortunately as well, that people were expecting a tax refund, and because they owed student loans, they didn't get that refund. They sometimes won't get all of it, or they might only get a portion. So this is important because it's going to negatively impact your ability to possibly do other things with money that you were anticipating. And then the same thing applies with Social Security benefits and anything that essentially would come from the government. Also, it could, and typically we also unfortunately see this often, will have a negative impact on your credit report. And that could impact your ability to borrow other loans. It could impact your ability to get a home, whether that is renting. A lot of landlords will pull credit reports, and buying, obviously, they will also pull your credit report for that. And there are some employers, depending on your job, that may pull your credit report. We have seen that as well. I know for my current role, my credit was pulled, so that is something that is common depending on your employer. So now we're going to take a little bit of time to just talk about the different steps about forgiveness and discharge options. As we know, we're a couple of weeks away from an election. So as I'm going through these, I do want to keep in mind it is an election year. We don't know what's going to happen. It's also COVID-19 time, so we don't know if these things may change drastically in the next couple of weeks, in the next couple of months. But these that you see on the screen are very common, and they've been around for many, many years. And I'll talk about public service loan forgiveness in much more detail than these, but I wanted to point these out. These are specifically for your federal loans, which is why another reason that if you're thinking about going back to school, or because of your employer, you may qualify for some of these and may not want to change or to refinance. And we will spend some time talking about refinancing and when it may make sense, when it may not. Now, some of the most common ones, closed school discharge. This has happened. This has been in the media the past couple of weeks, a month actually. So if you've seen something about schools that had closed and student loans that weren't forgiven, if you're wondering what were they talking about, well, that's what it is. If you attended an institution and they closed, your federal student loans can be discharged, meaning they are no longer, you don't have to pay for them. You don't have to pay them back. Teacher loan forgiveness is a very common one. A lot of teachers will take advantage of this. Perkins loan cancellation, that's another one that's common. And then total and permanent disability, discharge due to death. And the discharge due to death, I point this out because people may think that automatically if you were to pass away, your student loans may be forgiven or other debt that you may have. That's not necessarily the case. There are private lenders that may go after your estate if you owe student loans, but with the federal loans, those would be discharged, meaning that if you owed $10,000 and you had $10,000 in assets in your savings account, and I'm overly simplifying the state process here for the example, but that they would not touch that money that you have, that you had in your accounts. And that's specifically the federal student loans, they will be discharged due to death. Now, the one that's the most common, the most popular, the one that we hear a lot about, the one that has been, a lot of politicians will speak about, is public service loan forgiveness. And this is the one that I'm going to tell you what we know as of today. What will change, we do not know. So I want to provide that information for you at the beginning. And if you are currently enrolled in public service loan forgiveness, we continue to be enrolled, but especially keep an eye on it because we don't know what's going to happen. There are individuals that are saying, let's keep the program, let's change the programs. We truly don't know what this is going to look like in the next couple of months. But as of right now, let's all get on the same page as to what exactly is it. Well, public service loan forgiveness allows your federal student loans, so those are the subsidized and unsubsidized loans that Sarah mentioned, the Perkins loans, all of those federal student loans that could be forgiven after you make 120 qualifying monthly payment. Qualifying meaning that you made the payment within 2 weeks of the due date. The payments do not have to be sequential. So if you made 100 payments, went back to school, didn't have to make a payment, and then made 20 payments afterwards, that would count as 120. Now, for some of you, you might be thinking 120, well, isn't that like 10 years? It could technically be 10 years, but for most of the loans that are in public service loan forgiveness, they're not in that standard 10-year program because they would be paid off in that 10-year period. Instead, they are typically they're in a qualifying repayment plan, which is essentially an income-driven plan. That was the one that Sarah showed that had multiple. It was an overwhelming chart, but we wanted to show all the different options. That's another piece that potentially could be changing with public service loan forgiveness. There has been talk of making it a little bit easier so you didn't have as many or overwhelming choices when it comes to an income-driven plan. Again, we shall see. We don't know exactly where that's going to go. Something that recently did come about with the interest rates being at 0 was, well, are those qualifying payments? Because technically you're not making a payment. And there was some, in the past couple of weeks, it was said that yes, if you have a 0% interest loan and you don't make a payment right now, it technically will qualify as a monthly payment. So for those of you that think you may be eligible for public service loan forgiveness, and you would be eligible based off your employer. So you would be, because if you work full time with your current employer at a BIDMC, if you're working full time, your employer is a qualifying employer. You do full time, however, is not necessarily as determined by your employer. It's full time as determined by the federal government. We will email you this presentation. We also have a couple of resources on our website, but studentaid.gov is going to be the best place to go. There's a form that you can complete. You're not enrolling in the program. It's essentially an employment certification form. It's fairly simple to do. It's a lot of demographic information. It probably would take you no more than 10 minutes to complete it. And basically it's name, address, who's your employer, when did you start? And then you have an HR representative typically that will sign off saying, yes, this person has been working here for X number of years or X number of months. That is then sent to a servicer who will put it into the National Student Loan Data System, and they will track how many of your payments would qualify. Oftentimes we get the question, well, what if I do this today, but I actually have been working at a hospital or another qualifying institution, employer, for the past 2 years? Yes, they can go retroactively, so you could have prior months' payments apply towards this. That's why if you think you qualify, highly, highly, highly encourage you to go in, do this. I would even say try to do it before the election. Definitely try to do it before January of next year, January 1st, because historically, with the federal government, when it comes to the Department of Ed and student loans, most individuals are grandfathered into if they were in a program before and that program changes, they will continue to be in that program after the fact. So if you think that you qualify, it's best to do that now in case the program changes so that you're already on the list. You're already one that has been participating. It has, we have seen with the department, sometimes they'll come up with regulations and it could change pretty quickly. We've seen this, we've been living this in the past couple of months. As I mentioned, this is going to be the studentaid.gov /PSLF page is going to be your best tool. They're going to go into much more detail. That form that I mentioned is going to also be there. So that employee verification form, and there are other tools here. And you could also log in and continue to see if any of those payments that you have made would qualify. Public service loan forgiveness, one of the benefits, and actually before I even go into refinancing, but one of the benefits of public service loan forgiveness, or PSLF for short, is that if you have these loans forgiven, so let's say that I qualify and I have $50,000 that's forgiven. The benefit of that $50,000 being forgiven, opposed to other repayment options, is that it's not taxable. Sarah mentioned a couple of different options earlier in which you have the extended, you could be in an income-driven plan and technically have your loans forgiven. So I could, have my loans extended for 30, 35 years, and maybe I have 50,000, 20,000, whatever it may be forgiven, but that would actually be considered taxable income. So it's almost as if you had earned that and received that on a W-2. So your taxes for that year could be significantly higher depending on what your income looks like. With public service loan forgiveness, because it is, you're having the loans forgiven because you were doing good by working in public service, that will not be taxable. And that's why it's a much more popular option than just being in an income-driven plan and waiting to have those loans forgiven. And we've seen people that have been in those plans and then they get a very surprising tax bill. So we definitely don't want folks to be on that end. Refinancing is very popular. Right now, refinancing is extremely popular, especially with the rates being as low as they are. I'm not sure if you followed, but this week, the Fed has said that the rates are going to probably remain as low as they are for at least another couple of years, they think. Of course, we will see what happens in the future, but the rates right now are really low when it comes to refinancing anything. And what exactly is refinancing? First, want to make sure we're all on the same page. Refinancing is when you take debt from one lender and bring it over to another lender. Sometimes, not often, but sometimes you can refinance with the same lender. But for most cases, you bring it from lender A to lender B. The reason that it's beneficial for us as consumers is that lender B will typically have a lower interest rate. That's why I refinance. With federal student loans, one of the reasons that refinancing is more popular is that it allows you, and it's not just with federal, but with all student loans, one of the reasons that it's more popular is that it allows you to take multiple loans and put them into one. As Sarah discussed, you may have had a loan first year, the second year, third year. So you may end up with 4 different private student loans, one for each year. And then on top of that, you had your federal unsubsidized and subsidized loans. So you could end up very commonly with maybe like 12 loans. It's not uncommon for individuals to have multiple loans. Refinancing allows you to take all of these federal loans, private loans that you have, and you put them into one. A federal loan can be refinanced with a private loan through refinancing, through private refinancing. But you cannot take a federal loan, add a private loan, and keep it with the federal government. The federal government only has federal loans. Private lenders can do federal and private. And that sort of makes sense. The federal government, they're only going to manage the loans that they awarded and that you borrowed with them. It is important though, if you think about refinancing, it's not just looking at the interest rate. The federal student loans, the reason that they tend to be popular and the reason that most people tend to want to refinance with the federal, most of the people tend to borrow with the federal student loans are because they have so many different benefits. And as right now, we're literally experiencing this. I've given this presentation, I can't even remember how many times. And these are the last couple of months, we have actually seen people realize like, oh yeah, it is a benefit to have the federal loans because the rates are currently at 0%. If you had a federal student loan, bring it over to the private lender, you lose those benefits. You're no longer eligible. I did see a question that just came in that I think is a perfect time to answer now and the question was, can you still qualify for public service loan forgiveness if you refinance federal and private student loans? And the answer to that, unfortunately, you cannot, because those loans are no longer federal loans. And that's where, if you think you could qualify for any of these benefits, or anyone in your household would qualify for these benefits, you want to keep them with the federal government because it's an entirely new loan. And that's essentially what happens is you go to lender B and tell them, I owe lender A $10,000. Lender B pays lender A $10,000. That loan with lender A no longer exists. That has been paid off. It will show up on your credit report as paid in full. And now you have a new loan with lender B. And that new loan does not have typically, most often, will not have the same benefits as that other lender. There are times that with the federal student loans, what you could do is consolidate. So you can keep all your federal student loans together by putting them into a federal consolidation, which means instead of having those, let's say I have 2 loans per academic year in a traditional 4-year program, instead of having 8 loans, 2 per academic year, I want to consolidate those into one and keep them with the federal government. You can do that through federal consolidation. That is a weighted average. Most people will typically do that for the convenience so that they're only paying one servicer and one loan pool versus one servicer, and that their payment being dispersed amongst all of their loans. If you're going to do that though, with public service loan forgiveness, remember you need 120 qualifying payments to be eligible for this program. If you consolidate and you had made, let's say I made 100 payments and I only need 20 more, but I consolidate, even though they're still with the federal government, it's now a new loan. So I would lose those 100 payments that I have made. So you'd want to make sure with consolidation, if you are going to go that route, typically we recommend that at the beginning, when you haven't started making many, if any, payments, after your grace period, of course. So if I graduate in May, my grace period typically means that I won't go into repayment until around October, November. So maybe you consolidate around November or October, because what will happen with consolidation, which is through the federal government, or with the private refinance, is if I graduate in May and I refinance in May, my new payment is typically due within 30 days of that loan closing. So you lose that grace period, and that's something to consider in general. Other things to consider, and this is just with any loan, and I did say this is a good time to refinance, and I know we're talking about student loans, but we don't just live in one bucket. You know, our lives have so many different components and a lot of overlap. So even though we're talking about student loans, keep in mind, if you have an auto loan right now that's higher than 3%, you may want to refinance. If you have a mortgage that is higher than, around 3.5%, 3%, you may want to refinance. If you have any credit card debt and you're paying anything over in the double digits, you may want to consider seeing if you could either get a lower rate with your current credit card company, or maybe doing going with a different company. And I believe I mentioned, yeah, and also personal loan. If you have any personal loans and it's anything above 5%, I would also look into refinancing, because if you can increase your cash flow by reducing other debts, that's additional money that then you can apply towards your student loans or other personal goals that you have. With any of these refinance, these are things you want to consider. You want to make sure you have a high credit score. The higher typically will get you the lower the interest rate on the product. Some lenders are different. Some will allow you to qualify for one rate. It's going to depend on the product. I'll use us at HUCU as an example. Our mortgage, once you qualify, everyone gets the same rate. Our car loans, those are based off of credit score. So it's going to depend on the organization and the lender. You may want to check with them, but typically the higher the credit score, the more beneficial for you. There are different types of interest rates. We see this often with student loans as well. Fixed is typically a better option when you have a higher debt amount. Variable tends to be a better option when you have a lower amount, and what is higher and what is lower, it depends on your specific situation. For example, if I have $10,000 in student loans that I'm trying to pay off and I'm trying to refinance, and I have a variable option that's at 2% and a fixed that's at 4%, I might go with that variable knowing that the rate might increase, but because it's $10,000, let's say that I have 15, 20,000 in a savings account. That worst case, if my rate went up to 3, 4%, at that point, I may be able to pay off my loan sooner, then that might make sense to me. But if, let's say, my balance is 100,000, if it's 100,000 and the rate could go up to 4% or 5%, and the fix is fixed at 3 or 4%, I might go with the fix because I need the stability. I needed the payment not to fluctuate during this time period. And we have seen payments fluctuate, not so much in the past couple of months. Obviously with 0%, they've decreased or stopped, but prior to COVID, we had seen in the past couple of years, payments had increased, and some individuals were having a hard time with that, with the variable rates. Most lenders will not have prepayment penalties, and this is something that we still don't see as often, but depending on who you do business with, you want to double check. Most credit unions will not have prepayment penalties. Most of the big financial institutions won't, but there are some that will. So we just ask that you always read the fine print, and it does have to be disclosed to you if you would be penalized by paying off your loan sooner. GreenPath is a service that's available to all of you. They do have student loan counseling, but truthfully, we don't recommend the student loan counseling because there is a cost associated with it. We think that they do great services. They do budget, they do credit review, they're doing COVID-19 counseling. And the student loan counseling that they do, it is a good service. They actually will be on the line with you. They will help you call your servicer. So it's much more in depth. So for those that need it, it's available to you. Just be aware that there is cost associated with that. But the ones that we recommend that are for free, they're free because we pay for them and they're available to you and anyone in your household. You do not need to be a member of the credit union. We would love for you to be a member. We actually even have a referral campaign for those that are interested, but you do not need to be a member to take advantage of this because we believe strongly in the well-being of our entire community. So we pay for it so that this is available to you for free. And it's confidential. The HR office of your employer will not be notified. We don't look at this. This is for you, and they have flexible hours, including late. Today, they're open until 10 p.m. They're also open during the weekend as well. This is just to show numbers-wise why refinancing could be a popular option. And again, if you do not think you will use the federal benefits, and if you're taking advantage of that 0% interest rate right now, this would not be good for you for the federal loans. But maybe you have private loans in addition to your federal loans. You may want to think about refinancing your private student loans. I haven't seen the rates drop significantly with the private student loans. There really hasn't been much of a shift, but who knows? We will see what will happen, especially I think if the federal government, and this is just my thoughts, by no means am I saying this is what's going to happen, but I'm just giving you some things to think about, at least how I'm thinking about it, and maybe some strategies of how you can apply thinking about whether it's good to refinance now or later. But if the federal government keeps the federal student loans at 0%, private student lenders cannot compete with that. Most cannot drop their interest rates to zero because then they would not be in business. But what will happen in January will be interesting because once the rates go back up on the federal student loans, some people might want to refinance at that point. So maybe there might be better options because it may be a more of a competitive market. We will see. We're not quite sure, and especially the timing of everything with election as well. We don't know. So I would say if you are thinking about refinancing, maybe this month may not be the best option. Maybe you want to wait a little bit to see where the rates are going to go. But if you're a really high rate, maybe you do. You can refinance multiple times. Just be mindful that that would impact your credit score applying for multiple loans. But this is just to show the cost savings. Typically, people will say, well, no, I can't go down 3%. You can. I've seen people that were in the double digits with their federal student loans and were able to get them in the single digits. We see this with, not with homes with the double digits, but we do see with homes, we see it with car loans, credit card debt. So it is possible. Other things you can do is the repayment term, which is essentially how long the loan will be in repayment, can change, but you also could opt to continue to make the same payments you were making before. So if you were comfortable in this example making $552 a month, paying $552 a month, maybe you continue to pay that so that you can pay off the loan a little bit faster and save more money. And that's another reason that refinancing may be a good option. It's not always about how much money you're going to save. That is obviously very important. We want you to save money, but we want you to also think about the time. Like to be able to be done with the loan a year and a half earlier, that's a year and a half earlier that you don't have those payments. That's a year and a half earlier that you can take that money and apply it towards something else. So sometimes if the example here, if you're looking at, well, I'm only saving, $2,000 if I go down by 1%. That is true, it's $2,000, but you're done a year and a half earlier. That in itself might be good enough to help motivate us to pay off that debt faster. We do have many different resources. Another one that we have that we've put together is a worksheet, which basically goes through a lot of what we've covered today. If you are more of a traditional, I need to sort of print something out and go step by step, we have done that for you. You can go onto our website, hbcu.org/hub, and here you can download a handout that has additional information. I also mentioned our blog, and I shared a link to our blog earlier. We have, this week we put up a student loan post of what's happening with the servicers. We also share our blog through our social channels because things are changing often. So we want to make sure that you're aware. We recommend follow us if you want this information. You can also subscribe to our blog and get a recap of what's happening. And our blog covers not just student loans, but it covers credit, it covers finances for a family, taking care of elders, marriage. So we talk about a variety of different topics that are here to really help you navigate this, because as we've seen, money is one of those things that's just not every school teaches money. In fact, most don't. And we want to make sure that you have the best information available to you. And that is why we put these resources together.